likely to just follow the trend, what is popular now, they want to go for it. But the key important thing, I think this morning, just now, Mr. Mark Conin has mentioned, is that asset allocation actually is the most important thing for the investor. Because ultimately, whatever asset class, there is a so-called stabilized return that you can expect to achieve, unless we are talking about active management, which is a separate issue. So if you are just chasing for popularity of the funds and all these, sometimes you may misalign your own asset allocations, and if you enter and exit at the wrong time, it can really mess up your long-term. This is what we are talking about, long-term, whether your retirement plan or your children education plan. Because if you're in and out at the wrong timing, that's where you have a little bit mess up on your asset allocation, and therefore you were very likely unable to achieve your target. So capital protected fund, I mean, per se, there's nothing wrong about that. The key part is that how is it positioned within your own asset allocation space? I think that's the most important part that every one of us in the industry, as what Mark Conin has also mentioned, how are we aligned with the clients so that they know what is the objective?
Okay, taking up from that, asset allocation, Paul, you said it was important. How best can we educate the investors or our clients? Because I think like the 5 A's, the tenets for the UTCs just now, I mean, is there more that we can do to address investor expectations and concerns?
Practically, of course, I think in the markets there are plenty numbers of those asset allocation software that are available. Of course, being a consultant, you need to know the strength and the weakness of those software, which is ultimately is just a tool. You can't really just follow it blindly. And when it comes to so-called advising the investor, I mean, the fact is that sometimes I think most of us have experienced is that investor can be quite irrational about their return, right? I mean, normally you ask them how much return you want. The typical answer is always as high as possible, right? I mean, that is where the tricky part comes in, because you need to quantify with them. And again, this is what I normally tell investors is that if you are looking for 12% return, and if I able to achieve that return for you within the risk that we have already agreed to take, actually you shouldn't make much complaint if another investor is having a 20% return, because he may be looking for a higher risk. So that is where I think there are a lot, I mean, it's still a long way between us and the investor, so that we can align them towards actually their investment objective, rather than just purely looking at numbers, which is how much return do I get. It's more important to the long-term objective and how to help them to achieve the objective. Of course, within the risk they are prepared to take, if we can generate a better return, that's good. But you shouldn't just look at return and say, hey, the other guy is getting 50% return, and why you only give me 20% return? But if your risk and return rewards tells you that you should be happy with 12%, actually shouldn't have much complaint about that, isn't it?
Jeffrey, I understand your retail space, you have you have a pretty equal amount in the retail space and wholesale space. Education of investors, I think for all of us up here and down there, it's one of the biggest challenges. And like Paul was saying, you talk to an investor, you ask them what they want, of course, highest return, lowest risk possible, and that's something we can never manage. I mean, it's a delicate balance. What do you think is the best or most effective way from your experience in educating clients from your side?
Well, this is, I suppose, the perennial challenge. I think that throughout my career doing investments for clients, I think the biggest issue is, of course, the fact that clients would always emphasize returns over risk. And I think the biggest level of education is not actually returns, because returns is very easily understandable. It's the amount of risk that clients need to take in order to achieve the returns that they're after. I think speaking from what we have currently, I think the issue in terms of education is down, of course, to the advisor. I think the more educated the advisor is to the client, the more well off they are in terms of being able to provide the potential upside in terms of what could potentially be positive for making an investment. But they should also, of course, be very aware of what the potential downside is as well. And of course, we can give them as many tools as possible, but advisor education is critical at this point. And this is why it's such a positive factor to hear the President say just now that FIMM, as part of its SRO initiatives, is looking to also provide ongoing professional education to advisors. This is critical because if you look at the way that the industry is moving, we're moving away from a product push approach, of course, to an advisory approach. And the important part about going to the advisory part is that we are faced now with a confluence of many different products. We're not just talking about traditional unit trust products anymore. We're not talking about traditional equity funds. We're not talking about traditional fixed income funds, money market funds, and what have you. We've gone into, of course, capital protected plans, which look very simple on paper, but once you start going into the mechanics of it, you just see how complicated it is. I'm not saying that structured products are bad. I'm actually saying they're a good product on the surface, but when you look at the complications of it, it's important that everyone understands and is well educated in terms of what could potentially go right or wrong. Okay? So as the world gets more complicated in terms of financial products and so forth, financial advisors like ourselves need to be brought up to speed in terms of, number one, understanding what the basic fundamentals of investing is. That if you want any incremental returns, every additional ringgit or dollar of returns, you need to assume additional risk. There's no free lunch in our business. There's no free lunch in investing. When you try and achieve any 1% additional returns, you must take the incremental risk. Okay, so we must always remember and recognize that age-old adage that you have to take risks in order to earn the return. So when we go out and we speak to investors and so forth, we always tell them what the potential upside is. We also tell them what the potential downside is. And this really makes life a lot easier for us, because when times go bad, then at least investors knew that they had gone into investments with their eyes open. And the flag that we get as a result of that is far less.
I think as we listened to Mark just now, I think there was a highlight of the many distribution channels in the market. And I believe in the room today you have various distribution channels where you either direct UTCs or those from the IUTAs here. And I'm going to pose this question to my colleague at the very end, Chui Chui here. When we talk about product, education and product, Jeffrey said a keyword just now, product pushing. I think all of us face that problem because at the end of the day, as distributors or product manufacturers, you may not want to associate yourself with pure product pushing and move into financial advisory, but a lot of times the bottom line of it or what commissions you get of it can actually dictate how you manage or how you structure or understand the client's objective or risk appetite for that matter. From your perspective, Chuchi, because there's always, I think before the crisis there was always that expectation, sell what's sexy. What's new now, I go out and push it. What's old, because it kind of defies that theory of investing for long term. Nobody bothers to look at old products, There's talk about that, but I think only a smaller percentage of asset allocation. How do you asset allocate to a new product every time? You can't do that. There has to be an element of long-term investment. What is your perspective on that? How do you all manage it?
Okay, from distributor perspective, after the crisis, we see change in customers' risk appetite. Okay, they tend to be more conservative in their investment approach. They tend to actually, invest into more conservative, like what Datuk Noripa has said, into the balanced fund, into funds that can actually give you more certainty in terms of return, in terms of income distribution, in terms of income distribution. And, And customers after the financial crisis, they also tend to ask a lot more questions. Okay, they don't actually buy for the sake of buying, but they actually ask a lot more questions, especially after the Madoff and also the Sanford cases, the scandal, right? They actually wants to know who are the fund managers, okay, managing the funds, and also what are they investing, where are they investing, and how the fund managers actually investing their money, is it? And nowadays, we also see a trend of, customer not chasing for new funds, okay? They actually look at the track record.
A portfolio with a 10 ringgit return invested in 1,000 stocks, which is a lot more volatile. Surely it's the first one, right? Thank you.
Thank you, Dato'. You have any comments on propositions in terms of risk? I mean, listening to just a short 15, 20 minutes or so, I don't think the market has a problem in providing enough alternatives or propositions to the clients in order to make them feel better, more confident in investing. But I think the key space here, or the key gap we need to address, is the engagement of the investor, because at the end of the day, it's their risk appetite, their investment objective.
Right. Like what Dato' mentioned, in the Sharia space, normally, right, because being some ethical screening is done, normally the performance of the fund will be more stable, on a return, risk-return rewards measurement. So again, when we talk about risk, I think there are two angles we have to look at. One is from the fund manager point of view, which is the product manufacturer point of view, and another part is from the investor point of view, right? I mean, Dato' has mentioned a lot, even though it's from the Sharia space, how a fund manager manage risk, because the key issue that investor must understand is that a fund manager, right, will be allowed to take the risk within its mandate, right, to go for the return that's also within the mandate. So just like Jeff has mentioned, you want higher return, you have to take higher risk. I mean, there's no free lunch there. Now, it goes back to the investor point of view, is that what type of risk appetite they are looking at. And of course, the most difficult part, or rather to say, the mismatch between from the fund manager and the investor, of course, the UT consultant is the one that stands in between, is that from the fund manager point of view, normally we take risk as a quite symmetric, right? If the market goes up 10%, probably, let's say if you're index fund, it will go up 10%. When it comes down 10%, it will drop 10%. But for investor, right, individual investor, their risks are practically asymmetric, right? When market go up, they become more and more gung-ho. But the moment the market comes down, right, even initially they can agree that they can take a certain risk. So long as the market comes down, then they are getting a little bit jittery, and that's where I think consultant has to play a very important role in telling them that most of the products, except for, like Jeff mentioned, structured products, where the risk return profile is asymmetric, whereas most of the conventional products, even balance fund, equity funds, even up to bond fund, the risk return are symmetric, right? I mean, it goes 10% up, it will up, down also will be 10%. So that is the part. And then I just want to stress a little bit is that another issue is, I mean, when we talk about risk, also it talk about asset allocation. And more often than not, right? I mean, normally when we are from the unit trust space, we normally tend to ignore the insurance side. But if you're looking really into a proper asset allocation, actually you should take into the consideration of the investor, the so-called human capital. That means that the asset allocation between insurance and unit trust should vary according to the age. Because otherwise, it always tends to be either, I think most of us experience that A lot of investors will go for insurance because they believe the word of insured.